Hey guys, let's sit down and talk about something that is one of the most powerful but least understood forces in global finance. It's a story about a money machine that's been quietly humming in the background for decades, and it influences everything, from the value of your stock portfolio to the interest rate on your mortgage. So you probably remember that one week back in August 2024. I mean, we saw the S&P 500 just plunge 325 points in only 5 days. And for a lot of people, that was a really sudden, kind of painful drop that rattled their confidence in what had seemed like a pretty stable market. But the real epicenter, the place where the earthquake really started, wasn't on Wall Street. It was all the way over in Japan. Their main stock index, the Nikkei, had a massive drop. It was actually the single worst day for that market since the infamous Black Monday crash way back in the 80s. And that brings us to this central question, right? How in the world did one policy change in Tokyo cause this huge ripple effect across the entire globe? It feels so disconnected, but I promise you it's not. Let's walk through it step by step. The answer basically is the unwinding of a strategy that's been like a silent engine for global markets for decades. You can think of it as this giant river of cheap money that flowed out of Japan and, well, inflated asset prices pretty much everywhere. It's called the yen carry trade, and for years it was the world's cheapest money machine. For decades, you see, the Bank of Japan kept interest rates at or near zero. This made borrowing their currency, the yen, practically free. And that free money funded trillions of dollars in investments all over the world. The best way to really get this is to just walk through the process. It's surprisingly simple. Okay, step one, a big hedge fund borrows, say, a billion Japanese yen for almost nothing. We're talking like 0.1% interest. Step two, they immediately swap it for US dollars. Step three, they use those dollars to buy an asset like a US Treasury bond that pays, for example, 5%. And then step four, the difference between that 5% they earned and the 0.1% they owe, well, that's their profit. Ta-da, free money. Now this slide is really interesting because it breaks the trade down into its three engines. First, you've got the yield spread, which we just talked about, earning 5% while paying almost nothing. Super simple. Then you have the FX movement. See, for years, the Japanese yen was getting weaker and weaker, which meant your dollar assets worth even more when you converted them back. That's your second engine. And finally, the asset gain itself. That tech stock you bought was probably going up anyway. But this table also brilliantly illustrates the risk. If you look at that right-hand column, you can see that if any one of these engines breaks, especially that currency part, the whole trade can just completely blow up. So I'm sure you're wondering, why? Why was money basically free in Japan for so long? We're talking decades. This is where the story takes a really fascinating turn, and it moves from simple finance into history and power. Let's just mentally walk through this timeline. After World War II, Japan had this incredible economic miracle. Then came the 1980s, and a speculative bubble that was, it was one of the largest in history. At its peak, the land under the Imperial Palace in Tokyo was supposedly worth more than the entire state of California. Just think about that. When that bubble burst, it led to decades of economic stagnation and falling prices, what everyone now calls the lost decades. Now, the conventional story, the one you'll hear most of the time, is that those decades of zero interest rates were just an unfortunate accident, a long, desperate fight against deflation. But there's some really compelling research that suggests a different, more deliberate story. And this slide brilliantly illustrates the core idea from this controversial but fascinating book by an economist named Richard Werner. It's called Princes of the Yen. He argues the Bank of Japan, these shadow shoguns, as he calls them, intentionally used its power over money creation to first engineer the massive 80s bubble and then to prolong the recession that followed. The goal, he says, wasn't economic stability, it was political power, to force huge structural reforms on Japan's economy and to break the power of other government ministries. So the crucial point here is that their real power wasn't just tweaking interest rates like the US Fed does. No, they used the system called window guidance, where they could literally tell private banks exactly how much money to create and who to lend it to. Just imagine that level of control. First, they directed all that credit to build Japan's industrial champions, Toyota, Sony. And later, according to Werner, they weaponized that same tool, directing credit into speculative real estate and stocks to deliberately fuel the bubble. Okay, so let's move to today and see how this all builds. Because after decades of this policy, whether you think it was accidental or intentional, that free money machine is finally being turned off. This slide right here shows the huge before and after. We've gone from an era of zero interest rates and massive money printing, what economists call quantitative easing or QE, to a totally new era of positive rates and pulling that money back out of the system. quantitative tightening. It is literally like going from a fire hose of cash to a giant vacuum. This is a seismic shift. So basically, the math of that whole carry trade just starts to break down. It's not cheap to borrow yen anymore, and for the first time in a generation, Japanese investors can actually get a decent, safe return just by keeping their money at home in Japanese government bonds. That's the approximate value of net international investments held by Japanese investors. And this isn't just hedge funds. We're talking about massive pension funds and insurance companies. This is the giant wall of money that funded the world, and now that capital is starting to flow back home. It's a process called repatriation. Okay, this is the part that connects directly back to you. This isn't just a story about Japan. It's a story about global liquidity. You know, the oil that greases the wheels of the entire financial system. Think of this slide as the main hub of the whole issue. When that $3.3 trillion starts coming home, Japanese institutions have to sell their foreign assets. So what are they selling? Well, as you can see, they are primarily selling U.S. Treasury bonds. When you sell a lot of bonds, their price goes down and their yield goes up. And that leads directly to higher mortgage rates for you and me. At the same time, it forces selling in all those popular assets that were bought with borrowed money, like big tech stocks and crypto. You see, it's all connected. And you can see the direct impact right here on this chart. The US 10-year Treasury is basically the reference price for money everywhere on the planet. And just look what happens the moment the Bank of Japan makes a move, like it did in August 2024. The yield spikes almost immediately. The cost of money for the entire world goes up. So the crucial point to take away from all this is that a fundamental pillar of the global financial system for the last 20 years has now been removed. The cheap funding that inflated stocks, bonds, real estate, crypto, it's all disappearing. And this leaves us with a final kind of provocative thought. For decades, this massive flow of cheap money from Japan inflated asset prices all around the world. Now that the machine is being turned off, it just begs the question, what's left vulnerable? I hope this helps you understand the bigger picture. If you have any questions, just let me know.